Good morning, good afternoon, and good evening, everybody. Hey, welcome to this episode of the Notebook Show. As always, Scott Carson, excited to be here today. Today's episode, I want to go into a topic that I've gotten a few questions about from people. I've seen some people posting some stuff on Instagram and LinkedIn about one or two ways to buy your first investment property. And I think that's great if that's the only experience you have is going one or two ways, but there's a variety of different ways to get into real estate investing. And I wanted to share this with you guys, not only as a way to kind of help educate you, but also give you some hope, some guidance. I had a conversation a few weeks ago with my sister, who's got her primary house. She also has a rental property. Now, the rental property was her husband's house they grew up with. It was purchased by his mom. It's been paid off. They've owned it for a while, and they're making some rental income. And I said, "So, are you going to buy more rental property?" And they're like, "No, we were going to hold off till we can afford to pay cash for something." I'm like, "Well, that's okay. Why?" "Well, we don't have a mortgage." I'm like, "Okay, but do you realize that trying to wait to save to pay off a house completely when you buy it, it's only get more and more expensive to get rocking? You have all this equity in your investment property. You could tap into that equity and use it for a variety of reasons, to buy, for leverage. No, we just want to have enough cash." I'm like, "Okay, well, that's a limiting belief." And there's no offense. They're great people, love them, but they are school teachers. They don't have a wealth of information when it comes to real estate investing. And I know many of you that are watching this or listening to this may have friends that want to get into real estate investing or want to become investors, but they don't know where to begin because of A, limiting beliefs, like A, I don't have a lot of money saved, or B, I don't have good credit, or C, I can't afford to pay for a full property. Those are normal things. Why? Because that's how I felt. That's how I thought about real estate. You got to have a lot of cash, or you got to have great credit, or you got to know somebody who knows somebody, right? That's not the case. There's 5 different ways we'll go through tonight to help you buy your first investment property, and I'm going to throw a 6th one at the very end here. But the thing that you have to realize, ladies and gentlemen, is there's multiple ways to skin a cat. It's not the thing like I got to go to the bank, I got to have a 720 FICO score, I got to have a huge down payment or cash. You don't need that to do that. Okay, if you want to get into real estate investing, there's some ways that go along. Now, of course, every niche, every way has its pros and cons. There are advantages and disadvantages. There's risks with everything that you do. It's called investing, not guaranteeing. So only be prepared, to invest what you're comfortable losing. If you're going to be using your last 5 or 10,000 bucks, don't do this. Okay. There's some other ways you can get involved wholesaling, but we're not going to talk about wholesaling today. That's not one of these strategies for you to buy your first investment property. Wholesaling is really not investing. It's just flipping. There's nothing wrong with that. But if you want to get into the property ownership, investment property, where you start making cash flow and having all those amazing write-offs and do that stuff and really truly call yourself an investor, these are one of 5 ways, the bonus 6th way, just put on that investment cap. Now, the first strategy is, many of us we like flip this house. We like HGTV. I mean, millions of people every year go to Waco up here at Magnolia to see Joanna and Chip Gaines' house, right? They got famous for the whole flip this house, Good Bones. There's all of these investment shows on HGTV. And I was one of those people. I was like, oh yeah, I grew up in a hardware store. I can fix about anything. I like the idea of buying real estate. Well, I didn't know how to do it. Okay. I fell flat in my ass the first time until I learned the right. But the first way, if you see a deal, see a property that needs to work, how do you finance it? Well, you don't need cash. If you're on cash, you can go get what's called a hard money loan. An HML, a hard money lender. There are lenders out there that's all that they do, are loans to investors to fix and flip property. Now, there are some caveats about it, okay? A hard money loan is not a long-term finance option. It is primarily for fix and flipping. It's a short-term loan of 6 to 12 months, okay? It's got higher interest rates, 8 to 12, maybe up to 14%. Now, that can seem high. I'm like, oh my God, it's too high. But if you think about this, if you're going to flip a property, it's $150,000. You buy it for 100, and you're going to make 50 grand, and you borrow 100 grand. Are you going to let 8 or 12% in your interest fees if it takes you a year to stop you from making 50 grand? No, it makes sense numbers wise. Not long term, but short term it does. There's going to usually be a couple points of origination. That's a fee that the broker is going to charge. 1 point is 1% on loan. So if you're going to borrow 100 grand, you're going to pay 1 to 3 points in fees. Now, usually what's going to happen, it will vary a little bit, but a lot of times hard money lenders will lend off of what's called the after repair value, the ARV of a property. So if you're going to fix it up and the property is going to be 150, that means you could probably borrow up to 100 grand. So if you can buy that property, it probably needs work, and figure in all your repairs into that 100 grand, you may not need to bring any cash to the table. All right. In today's competitive world, you probably got to expect to bring 20, 30% of the purchase price to the table in cases. And it's usually not credit based. They're not usually going to care about your credit score. I mean, they may look at it, may ask you, and you have a horrible credit score, they may not do it. But this is if you've got B and C credit, if the deal makes sense, you can usually find a hard money lender that'll lend to you. Of course, as always, you got to be familiar with, have a crew, repairs. I would not get into hard money lending or take a hard money loan if it's your first deal. There's other ways to do it. I'd make sure you've got multiple bids when it comes to contractors. If you can do the work yourself, you're going to save some money, but also don't let you have to do all the work yourself, slow you down. And that's where a lot of people do. They save money, they go buy an ugly house, they take forever to fix it up, and sometimes they over rehab the property and they can't get for what they want to. Hard money lenders are a great way if it makes sense to take it down. Of course, hard money lenders will often review what kind of repairs you want and see if it makes sense, and they're often a really good judge if it makes sense as a project. Otherwise, they'll tell you it's too expensive or you need to get it at a cheaper price. I've used hard money lending in the past. I've been a hard money lender. If you're interested in that fix and flip model, just be careful of the days on market and the time to sell, because that number is obviously creeped up. But hard money lending there's plenty of lenders out there. They don't care what your credit score is. If you've got some money to put down, or you want to borrow, partner with a friend who's got some money and go in together. And this is one of the great ways that a lot of investors get started fixing and flipping property. But like I said, it's not a long-term strategy. Now, if you want a long-term strategy, then what you want to look at buying a property and using what's called a DSCR loan. And DSCR stands for debt service coverage ratio. And what it is, there's lenders that do these DSCR loans totally 100% based on the coverage of the debt. That's why it's called debt service coverage ratio. Okay. It's driven 100% by property income. A lot of apartments, a lot of commercial properties are financed with DSCR loans. And usually the underlying number is they want to see a debt coverage ratio needs to be at 125%. So if your mortgage and costs for that property, mortgage, insurance, taxes is $1,000 a month, they want to see you bringing in $1,250. Okay. So that's what they want you to be at 125%. Otherwise, if it's below 125%, it's not considered very good. If it's below 1%, it's bad. If it's a 200% where you get twice the amount of income compared to your expenses, that's a really good deal. It's almost a slam dunk to get financed. It's longer term financing, can be up to 30 years. All right. And a lot of DSRs will have some different ways to make it a little bit more affordable the first couple of years. A lot of times these DSRs will do interest only loans like the first 10 years. And then after 10 years, it goes to a full principal and interest payment. So it's going to save you a little bit of money, make it a little bit more optimized for cash flow in the first 10 years. Of course, what's going to happen in those first 10 years? Your hopefully value of the property is going to go up and appreciate some. You may not write down the principal amount of the loan a lot, but you got some extra cash flow for those unexpected expenses. The interest rates are going to be usually 1 to 3% higher than what your traditional 30-year fixed rate on your primary residence is going to be. A lot of DSR lenders are still going to want you to bring some money to the table, usually somewhere between 20%, so that they're financing at 75 to 80. Sometimes you can get a little bit higher. Just depends on the relationship with the bank and what's going on in the project. But once again, it's almost 100% based on the income of the property, not on your credit. All right. That's the great thing about that. If you can find a property that you can get rented, or you have a motivated seller who wants to move a property, or you can take one down and put some renters in there because rent rates are high in that area, and your DSCR looks to be good, hey, you may be able to get rock and roll along without having to do a lot of work. Yeah, borrow a little bit of money, friends, family, raise some private capital. It's a whole different thing we'll talk about on a different episode. But DSCR loans, hey, they're very popular these days, and it's something for you to get into. Start right now. So if you got a down payment and you can make 125% off your debt coverage and everything, there you go. It's pretty cheap money too. Okay. Now, yes, interest rates are like 6.5%, so you might be paying 6 to 10% on a deal here. But if your numbers will make that, great. get a DSCR loan when rates drop down a little bit more, go refinance, make more cash flow. Third thing, if you don't have a hard money lender, don't want to do a DSCR, then owner financing is an option for you when it comes to buying real estate. And we call this kind of buying on terms. And this is, we see this a lot right now, especially as interest rates have crept up a little bit higher and properties have stayed on the market longer than expected. You're starting to see more owner financing options out there. Now, this is where basically the property owner finances the home, finances the property to you, the buyer. Okay. You might need some down payment. Normal down payment may be 10%. This works really well if you have a big chunk, but maybe you can't qualify traditionally because you're self-employed, you haven't done your taxes. There's a whole lot of owner financing that takes place. Actually, more owner financing deals that take place than conventional every year across the board. This works really well right now with motivated sellers, people that can't sell their house. They got to move. They've gone through divorce. They got to sell it, and they need something to cover their monthly payment. So they may be willing to owner finance the property for it. It's also, too, you'll have a lot of real estate investors that are tax savvy. They don't want to sell their investment properties because they're going to get hit with a huge tax bill. So they may be willing to owner finance to kind of spread out their tax burden and just get taxed on the income coming in off of that owner finance. Now, there's a variety of different ways. I've seen owner finance deals as little as 5% interest rate, all the way up to 10, 11%, or 12% or greater. It all depends on a different situation. What you look like as a borrower, how much down payment you have, and going from there. Now, don't get me wrong. Some places you can get owner financing 100%, okay? Or they'll structure the deal to oversell the property, overfinance the property a little bit, but you can get the full purchase price. There's a couple different ways to structure owner finance deals out there. Interest rates are going to be a little bit higher than your traditional 30-year if you went to a bank and got it, okay? Just because the investor who owns the property is going to want to probably get a pretty decent return for the investment. Some of the note buyers out there that are buying owner finance notes are going to want to see an 8%, 9%, or 10% or greater interest rate that mortgage, okay? Like I said, it's usually going to be 90 to 100% of the purchase price. 10% down is usually the ballpark we tell people to do. They're going to offer up owner financing, but we've seen people do less. We've also seen people do more. And like I said, it's usually not credit-based at all. So if you see somebody who's motivated to sell and is wanting to get off, and you can take that over and, they'll owner finance the property to you, the deed transfers to you. You're not responsible for taxes and insurance and upkeep of the property, but you can get in without having to put a 20, 30% down and have to jump through the hoops of bank financing. Owner financing is the way to go. There's a lot of people that are doing that, buying investment properties via owner financing, because the seller can't sell them traditionally because of issues. They're fixing them up, turn around and selling them, and then paying off the owner finance note. Okay. As always, you want to double check if you're doing this once or twice a year and that's it, then you can do it pretty easily. I would still consult an attorney, whether you're originating a loan or you're buying an owner financing. Double check everything. All right. And you've also got to be, if you're offering financing, you're doing it multiple times, or buying from somebody who does it multiple times, they've got to make sure that they're Dodd-Frank compliant and that the loan is not predatory. So you want to make sure they go through a licensed mortgage loan originator. And that's something to take a look at. If you'd like more information on that, reach out to me. I'd be glad to share more about that. Another one that's been very, very popular lately I've got a family member doing this, a couple realtor buddies of mine, some friends. Wait a second. Let me go back. Let me take this back. It's buying subject to. This is another strategy that's really starting to blossom because we had such a great period with low interest rate. People that bought and got a 2-3% mortgage, but guess what? Now they've got to move. They can't sell the property, or there's issues where they've gone through divorce. They're moving and can't move it can't sell the property as fast because of the way the market is. So buying subject to, what does that mean? Well, that means that you're buying subject to the existing financing. I've been doing subject to deals for years. You're basically taking over the mortgage payments, okay? The borrower may owe something. This is great when it's a low interest rate. You can step into a property, take over, start making the mortgage payments. You may need some money, may need to pay the borrower who's selling, letting you take it over, some money to walk away, some money towards their equity. That can be structured differently. You may need to make up some back payments if they fall behind 2, 3, or 4 months, okay? It works well when the motivated seller is very motivated and can't afford to the mortgage payment because of something that's happened. you're not taking advantage. You're literally helping them avoid a foreclosure. Late payments will only affect them for 24 months, but a foreclosure will affect them for 7 years. Okay. And it's usually desirable when you can buy via subject to when it is a low interest rate. Okay. I prefer to buy when there is some equity. Some people will buy and take over subject to when there's no equity or a little negative equity. I never understood that, but they hope over time that by paying down that mortgage, that negative equity will go away, or they'll build more equity or some equity when there's zero equity because of appreciation of the properties. Okay. Now, what you do when you take this over subject to is up to you. There's a couple different ways. Some people buy subject to for their own investment to move into those properties of their own. Others will buy them and turn around and rent them out, or they'll turn around and owner finance them to sell them to somebody and make the difference. If they've got a 3% mortgage on the underlying mortgage, they'll turn around and owner finance it at 8% and make a 5% difference in between, along with a down payment and other things. Okay. As always, highly, definitely want to check and consult with an attorney. Some states are okay with this, others frown upon it. Otherwise, there's specific ways to structure the deal. So always consult with an attorney. You're going to buy via subject to. One of the biggest caveats we hear is, oh, this violates the due on sale clause. Yes and no. I've only had a couple subject to deals where the bank actually came back and enforced the due on sale clause. Most of the time, as long as the bank is getting paid, the tax is getting paid, and there's insurance on the property informing, where the bank is the plaintiff, they're going to pay off something, they don't care. So there's ways to specifically structure it via land contracts or LLCs. Just make sure you get with an attorney to structure this properly. Okay. Don't try to do this on your own because you can really screw this up. Okay. Next way is what's been very popular, as I was talking about before, with some friends, family members that are doing this. And this is short-term rentals, not buying a property and turning it into an Airbnb, but what they're doing is something called a rental arbitrage. Okay. Now, if you buy a rental property in a DSCR and you get a DSR loan and you're going to do a short-term rental, that's completely fine. But you don't necessarily need to have that down payment to buy the property. I have friends that what they're doing is they're going to landlords with a property for rent or a home for rent. Maybe it's a condo or an apartment unit, and they're renting the property for a year. They're signing a 1 year or 2 year lease with the idea that they're going to sublet this on short-term rentals. Now, you got to be very careful about this. You want to make sure and let the landlord know this is what you're planning on doing. If they won't allow you to do this, then don't do this. This will violate the lease, okay? You're going to need some money down, not like 20% or 30% like you're buying the property, but you're going to need some money to provide furnishings, beds, drawers, entertainment in the house, TVs, things like that. So, I've got a buddy that he puts $10,000 to $15,000 in furnishings into each one of his rentals, and he's gone from 0 to 25 of these short-term rental arbitrages in the last 90 days. Okay. You want to definitely check your local ordinances. Some cities are very frowned upon these things, like here in Austin, Texas. You got to have a specific license to do it here. Others completely ban them all on. Some apartment complexes won't allow them, or they'll allow only a certain specific. So always check with the management and the ordinances. I will tell you right this, you can leverage, though, services like Airbnb, VRBO services to help you with bookings, to help you with some management, cleaning. They can really do a great job. But it is much more hands-on than just a traditional 30-day rental or a 12-month rental. There's more income because it's a higher dollar per night thing, but you also run into, you've got to have cleaning on staff. You're responsible for the upkeep of the property, and it can kind of run you to death a little bit if you're not expecting. So I would not be doing this outside of your local market to begin with. As always, if you can't invest in your own market, that's a great thing. But if you're in a difficult market like California or other places, hey, there are other markets to go to, and just be familiar with the markets that you're in. Now, those are the 5 ways of buying your first investment property, basically, or having a real estate investment. The bonus way is something that I've been doing for the last 6 years, and that's called buying notes. Some people frown upon the idea of buying real estate because they don't want to deal with toilets, tenants, and trash outs. They don't have the experience of dealing with rehabs or fix and flips. They don't want to deal with that. That's the thing. They don't necessarily want to own the real estate. They like the cash flow aspect of it. And a lot of people, if you're buying a rental property, what we see with a lot of our friends who are renters, or not renters, but rental or landlords, is that they're looking to get a $250 to $300 a month cash flow on a monthly basis. But with notes, you can often buy a note and get that cash flow immediately without the deal in toilet, tents, and trash outs, without having fix and flipping, in a lot of ways. Now, what is notes? Note investing is where you buy that note from the lender, whether it was owner finance, you buy that note from the seller, or you buy it from the bank, or you buy it from a lender or another hedge fund. We've bought thousands of notes in the last 20 years. Now, you can buy performing notes or non-performing notes. A performing note is a note that's been performing. The borrower's been paying on time. You could probably buy a performing note at an 8 to 10% cash and cash return. Maybe greater, maybe less. It just depends on the scenario. A non-performing note is where you're buying the note and the borrower has not performed. It means they haven't paid in at least 90 days or longer. You'll buy non-performing notes at a bigger discount than performing. The borrower still owes what they owe, and you've got a little bit more work with a non-performing, of working to either get the borrower back on track with payments, some sort of loan modification, or going the route to liquidate or get them out of the property through foreclosure or selling the property or cash for keys. There's a whole variety of exit strategies. We don't have time today for those. Make sure you follow me and I'll share with those in there. But the thing is that you're buying the note, the collateral, the security of that note is the underlying home, is the asset. And I highly recommend you only buy first liens, because if you're in the first lien position, the only thing that can wipe you out is taxes and God. Well, if you've got insurance, you're good. If the taxes are paid, you're good. Okay. I would not buy second liens or junior liens, especially not right now. They're really overpriced and they're in a much riskier position than first lien. Now, don't get me wrong. If it's a small amount of money, yes, you can step in and buy second liens usually be able to buy them at a lot cheaper rate. It may be cheaper to buy that route, but I like being in the first lien position. That's my position in my personal opinion. But you're buying that note usually at a discount for cash flow. And in the words of a Bill McCarroll, note investing is the only strategy that we know where you decide what kind of return you want your money to make. If you're happy making 8 to 12, great. If you want to make more, 15 to 20, great, you can do that. What I like about note investing is a lot of times you'll buy these notes, you become the bank, you're not in charge of rehab, you're not dealing with toilet stints and trash outs or the property management unless you foreclose, and there's professionals you can hire for that. As always with note investing, there are some risks, there's some pros and cons. Each stays a little bit different. Do not try to do this on your own. Do not try to be a note investor from just listening to YouTube University or podcast. You get with licensed professionals, servicing companies, attorneys, and you really need a coach to walk you through that. And I'm here to help you out with that. Okay. As always, consult professionals. Like I said before at the beginning, every strategy has pros and cons. Know your risks, know your market, know your tolerances. What do you want to accomplish? What do you want to do? What do you not want to do? Going to your local real estate investor association and meet groups is a great way to get your feet started, get your feet wet, talk to people there, talk to professionals that are doing the strategies, learn, take a class, get a coach. Getting educated is going to help you out with a lot more than trying to figure out on yourself. The biggest mistake I see new wannabe investors is they try to figure it out on their own because they think they know everything. I'm raising my hand and I can call myself on that because that's how I felt and I see it happening. Oh, I'm smart. I'll figure that out. Oh, I got 20 years as a realtor. My dad was in the rehab. Trust me, it's a different market, different time. Get educated, get learned. It's called investing too, ladies and gentlemen, not called guaranteed. All right. If you can't afford for the 20 or 15 or 10 or 50 that you're going to put into the deal to lose that, don't do it. Keep it on your own. I always am a big advocate of investing yourself and understanding that never invest in something you don't own. Okay. And as always, results will vary on experience and deal flow. And each deal is completely different. But guess what, ladies and gentlemen? There's multiple ways for you to do with small amounts of money, limited amounts of money, no credit, bad credit. These are 5 plus the bonus of 6 with note investing. Note investing doesn't care what your credit score is. All right. You just need cash to go do it. So I encourage you. Hopefully this was helpful. If you like this, make sure to share it, subscribe to the channels, follow me. We are here to help you. As always, guys, we are here to help take you to the next level. Subscribe to my channel. Check out weclosenotes.com. That's my main website. And if you'd like to jump on a phone call to talk about any one of these strategies, I'm glad to recommend 1 or 2, depending on what you say, or put you in the right path to success. Don't let money, credit, or lack of experience stop you from investing. So go out there, guys and gals, take some action, and we'll see you at the top.